The next presentation is by Flury. He is the founder and CEO of Algotrader, and he will talk about untangling digital asset trading. Andy, the stage is yours.
So, hello, welcome everybody. Lots of familiar faces, good to see you. My name is Andy Flury, I'm founder and CEO at Algotrader. We are a provider of digital asset trading and management solution for financial institutions. Thomas already talked about the challenges banks are facing when offering digital assets. I will kind of talk about the same topic, but take a little bit a different angle. I would like to share some insights on what banks need to offer crypto and digital assets to their clients. As most of you know, crypto markets are extremely fragmented. There are literally hundreds of exchanges out there. On the other hand, banks are missing the technology stack to seamlessly automate the entire trading lifecycle across the core banking, trading infrastructure, and custody. So the actual challenges banks face are counterparty risk from having to deposit collateral on exchanges, operational risks from manual asset transfers and manually executing client orders, and execution risk, especially in high volatility events, market crashes, when exchange APIs become unresponsive and blockchains become congested. So at Algotrader, it's our bread and butter to solve these challenges for our clients. So we achieve this typically by integrating and fully automating the entire trading lifecycle. So, what exactly is best execution when talking about trading of digital assets? I put this here, the definition as we see it. It's to buy or sell at the best possible price available in the market. That's a no-brainer. But what often gets neglected, it's also the last part of the sentence, at the lowest possible cost and risk. So throughout the next few slides, I will elaborate on the 6 main challenges that banks face when trading digital assets. So the first and probably most important requirement is market-wide connectivity. Being able to send orders to multiple exchanges, brokers, and OTC desks has mainly 2 advantages. It allows you to execute client orders even if one venue goes down, then you can just reroute your order to the next exchange. The other one is to take advantage of market inefficiencies. In the crypto market, we often see what's called a cross spread. So what that means is that the best bid on one exchange is higher than the lowest ask on another exchange, and you can actually profit from that. However, achieving market-wide connectivity is not that simple. You need a specialized order and execution management system. Unfortunately, many crypto exchanges and brokers do not offer a standard API. So what you would require is a specialized adapter to use those REST and WebSocket APIs provided by exchanges. And this is, Thomas talked about buy or sell. This is definitely not something you want to build yourself, and leave that better to specialized technology vendors. If banks cannot and don't want to source liquidity from multiple venues, they risk of not being able to trade at all in times of high volatility. So the next crucial requirement to achieve best execution is to fully automate the entire trading lifecycle. The biggest potential reputational damage and financial loss arises from human failure, such as fat finger trades or wrongfully entered deposit and withdrawal addresses. So automating the entire trade life cycle is crucial for this. As a consequence, if banks don't implement this, they have to deal with manual overhead and operational risk until the entire pre-trade, trade, and post-trade processes are fully automated. Next one, you want to make sure that client orders are executed as fast as possible. Any delay means market timing risk. As market conditions move continuously, the best price for an order might be on exchange A, a second later it might be on exchange B. So you need something like a smart order router that automatically picks the venue that currently has the best price. You also want to ensure that large orders do not move the market and cause slippage. So for this, you typically use execution algos like TWAP and VWAP that split up large orders for you. Next one is counterparty risk. That's probably the biggest barrier to entry for banks when trading crypto exchanges. Whenever you want to execute an order on an exchange, you actually need to deposit funds onto the exchange in order to trade. So, as the popular saying goes, not your keys, not your coins. So in an ideal world, you would obviously hold on to your assets right before the moment you want to trade. The problem with pre-funding exchange accounts just in time is market timing risk and network fees associated with transferring your funds prior to executing an order. So as a result, banks often prefer to trade with OTC desks instead of exchanges that do offer credit lines, so you do not need to fully deposit your assets prior to trading. The compromise, however, is that OTC desks typically require a quite substantial minimum monthly volumes, which might be prohibitive if your bank is just about to get started offering digital assets. Number 5, to benefit from best execution across multiple exchanges, exchange accounts need to be pre-funded. That's what I just talked about. So the amount of working capital locked onto exchange accounts increases obviously with each additional exchange account you wanna trade. So apart from the resulting counterparty risk, it also increases the cost of liquidity. And in an ideal world, again, this multiplication of locked-in funds would be eliminated if all the assets were kept into a central liquidity pool. Some financial service providers have identified this and do offer solution whereby you as a client can trade exchanges directly, but the service provider will act as a central financing counterparty sitting in the middle. Alternatively to that, partners like Fireblocks offer services to instantly fund exchange accounts off-chain. Lastly, a still somewhat underestimated factor is execution privacy. If institutional wallet addresses have been identified by the public, large on-chain transfers to an exchange prior to executing an order can easily be front-run by market participants, and this actually happens today. So ideally, it should be possible to privately fund your exchange accounts prior to triggering an order. So in order to overcome these 6 challenges, banks absolutely need streamlined, secure, and private execution and settlement connectivity to multiple venues. As market crashes have shown over and over again, relying on a single or just a few trading venues is not the solution and presents the banks with huge risks. Therefore, any bank, looking at offering digital assets should strive for a diversified execution connectivity to ensure client orders are properly executed. As you can see, in crypto, the solution to best execution is actually not just about looking at prices your client orders get executed. It's the optimization, streamlining, and automation of the entire trading lifecycle. This is the only way to truly offer best execution to your clients. So what's the solution? Most of our competitors are fighting over the increasingly populated buy-side market. We at Algotrader, we have been specializing and analyzing and understanding the challenges banks are facing. Our mission is to unify the entire trading life cycle with a fully integrated tech stack to enable banks to achieve true best execution. So what exactly do banks need to offer crypto custody and trading to their clients? I know this topic has been talked about before. So in addition to the core banking system that you see on the left-hand side, institutions need an institutional-grade crypto custody solution to safeguard the private key. So partners like Metaco, they're here tonight, Fireblocks, and many others do offer solutions for that. Then banks obviously need a component for order and execution management to handle the connectivity to the venues and also properly execute orders. So this is one part of what our solution does. And finally, and most importantly, banks need an orchestration layer to coordinate all other components and to automate processes like risk and liquidity management, pre-funding, management of client spreads, reconciliation, settlement, hedging, on and on and on. So this is the component you see second from the left. Currently, Algotrader is the only solution in the market that fully offers this sort of orchestration layer. Now, there is one more aspect I'd like to mention. When in our experience, when supporting banks, and this is about modularity and customization. Every bank we have worked with has a completely different setup, different processes and different requirements. So right now, there is no one-size-fits-all for banks. We have quite a few number of years and experience in customizing our platform for the individual needs of our clients. Be it a systematic hedge funds that trades quantitative trading strategies, be it discretionary traders, or of course, banks. We have probably seen it all. So this modular approach of our system gives clients the ability to pick and choose the components that are required for their particular use case. And then we integrate seamlessly into their business workflow and IT landscape. Integration also something Thomas talked about just before. So that's it from me today. I hope I was able to shed some light on the key challenges and entry barriers banks are facing when launching a digital asset offering. We look to partnering with you in your digital asset journey. Thank you from Algotrader.